Ben, you just mentioned that you prefer to invest in not so easy times. Is that now your period, the period of value ahead of us? Is growth that, or how do you see it?
Yeah.
Are you happy now?
I mean, look, I'm never happy. It's happiness is kind of an anathema to, you know, my life and career. But I am excited about the entry prices coming down to sort of defensible, realistic levels. When we talk about value investing, and I've gotten permission from my panelists just to make sure we're all on the same page here, because when I took value investing at Columbia University for my MBA, so like there is an answer to what value investing is academically, and just to ground us on the principles, it's, you know, Graham and Dodd, Warren Buffett's iconic style. First and foremost, you know, don't lose capital. Second rule, don't lose capital. You know, and then once you've got your capital preserved and protected, you then focus on a return of capital with the margin of safety. You don't take technology bets writ large, like whether or not beta or VHS is going to win. That's not a bet you take. Will people watch movies? That's a bet you take. How they watch them? Maybe not so much. Patience during robust economic times to maintain pricing discipline is probably the hardest single element of value investing. And it was near impossible to do that for the last couple of years. So in that sense, you know, I feel like value investors' patience is about to be rewarded. And you must factor in interest rates. The cash flows of the corporations and, you know, that you're investing in will be affected by the macroeconomic conditions. So that needs to be priced in. I don't know if it is fully yet. And then you have to ask yourself, am I investing in a borrower or am I investing in a lender? And lenders include insurance companies, banks, you know, et cetera, et cetera. The people lending money in a rising rate environment are better off than the people that are borrowing money in a rising rate environment, like broadly speaking. The last tenet, which is different from Warren Buffett, because I'm not him, I'm not as smart as him, he's, you know, kind of an investing god. He doesn't need to do due diligence. We do extreme amounts of due diligence, okay? So that's value investing, just to get everyone grounded. And on the next page, I'll talk about how you actually put that into practice, or we do, which is the evolution of Graham and Dodd and Warren Buffett, you know, and then Seth Klarman with the margin of safety concept, is how you actually implement value investing in a private equity construct, which is you make sure that your price is what you pay and value is what you get, right? And I don't mean to lecture, I apologize if it sounds that way, but the price of something and the value of something almost are never the same number. So I think in the past couple of years, the price has probably been north of value, and I think we're getting into a time period where price is going to be south of value. And that's a very good time to be a value investor. And the other times, it's very frustrating. Beyond that, you know, I think Cerberus probably did number 2 the most aggressively, which is you get yourself an additional margin of safety by enhancing management, operational efficiencies, you know, experience and competence. And lastly, what we do is on internal management information systems and technology systems. You know, it's not super complicated, right? If you have D and F grade information going to management teams, even if they're A pluses, they can only make D or F decisions. But if you have A plus, you know, relevant, timely, accurate, transparent data going to A plus management teams, you're going to have A plus decisions in general, right? So you need to have both of those in place to give yourself the biggest margin of safety, with the goal being to isolate asymmetric risk and return opportunities, meaning you're getting compensated well in excess of the risk that you're taking. So that's value investing, that's how we go about it. Thanks for showing those slides, and to my panelists for allowing me.